Hi guys, my name is Siachen and welcome back to my channel ACCA and beyond. So in previous video we had started with chapter number 7 revision, and in this video we are going to continue with it. So let's get started. Okay, so if you remember, the auditor can never transfer responsibility. No matter who helps, the final opinion is always the auditor's, and usually the audit report doesn't mention using others at all. Now, can internal auditors directly help the external auditor? Yes, but with strict conditions. First, in some countries, it's not even allowed. Then the auditor must check are internal auditors competent and objective. If there is bias, can it be controlled? Also, internal auditors cannot be given high risk work or anything involving major judgment. And the plan must be discussed with those charged with governance to make sure the auditor isn't overusing internal audit. If they do assist, management must give written approval. Internal auditors must confirm confidentiality, and the external auditor must supervise and review everything. Basically, they help but under full control, and throughout the process, the auditor stays alert. Are they still objective, still competent? Finally, documentation. The auditor records the evaluation of internal audit and why and how much work was given, who reviewed it, and all written approvals. So remember, internal audit can assist but only under strict rules, full supervision, and the auditor stays fully responsible. Okay, so let's talk about use of service organizations. Many companies don't do everything themselves. They outsource things like payroll, receivables, or pension management. Now, this creates a challenge for auditors because some data is no longer with the client, it's with the service organization. So, auditors may need to collect evidence from the service organization as well. When planning the audit, the auditor first needs to understand the service organization, what service they provide, how important those services are, and how they affect internal controls. They also look at how closely the service organization and the company work together and what the contractual relationship looks like. Then comes the key part, risk assessment. If the auditor considers things like the reputation of the company, um, whether there's an external supervision, how strong their controls are, past errors or issues, and how much their client monitors them. Uh, okay, let's finish this topic. So, how does auditor actually get information about a service organization? In most, the most important source is a type 1 and a type 2 report. So, a type 1 report, this explains the system and checks if controls are properly designed, and a type 2 report, this goes one step further. It checks design and whether controls are actually effective. So, obviously, type 2 report is more useful. But before relying on these reports, the auditor checks, is the service auditor competent and independent, and which standards were used. Other ways to get information include contacting the service organization and visiting them, or even using auditor to perform procedures. Now, once risk are assessed, the auditor must decide, do we already have enough evidence? If yes, great. If not, more procedures are needed. If controls of the service organizations are expected to work well, the auditor may rely on a type 2 report. But they still check things like, is the report period relevant? Does the client have their own supporting controls? And how recent the testing was? They can also perform their own test, or use another auditor if needed. The auditor should always ask the client, has the service organization reported any frauds, or are they aware of any issues? Now, if the auditor can't get sufficient appropriate evidence, they have no choice. They must give a qualified or a disclaimer opinion. Also, just like experts, the use of a service organization or the auditor is not usually mentioned in the audit report unless there is a modified opinion. Uh, Now, let's look at the benefits of using service organizations. They're independent, so evidence is more reliable. They're specialist, so fewer errors. And sometimes auditors can directly rely on evidence. But here is a big drawback. Auditors cannot have direct rights over the service organization's records. So, if access is denied, there's a limitation of scope. And if evidence is not obtained, again, modified opinion. Now, finally, selecting items for testing. Auditors have three options, and the first one is 100% testing. This is for used when the population is small or when the auditor wants very high assurance. Second method, selecting specific items. Here the auditor picks items with certain characteristics like high value items, all items above a certain amount, or items that give useful information. Now, important point, this is not sampling, because not every item has a chance of being selected, only specific ones do. Now, third method, which is sampling. Sampling means testing less than 100% of items, but every item has a chance of being tested. Yeah. This has the auditor draw conclusions about the whole population. Why do we use sampling? Because testing everything is too costly and time consuming, and auditors only give reasonable assurance, not 100%. Now, key thing, the sample must be representative. If it's representative means that it should reflect the whole population. If it's representative, the conclusion from the sample equals to the conclusion of the whole population. Um, to improve this, auditors can increase sample size or use stratification. Stratification simply means breaking the population into smaller groups with similar characteristics. Um, that's this. Why, so why do we use stratification? To reduce variation and making sampling more efficient. For example, revenues can be split into product A, B, and C. You can test each product separately and then apply the same result to the group. If one group is immaterial, you can even skip it. Easy. Now, types of sampling. First, statistical and non statistical sampling. They use random selections plus probability theory. Methods include random selection, systematic selection, like every 50th item, and monetary unit sampling, focusing on higher values. Second, non-statistical sampling. This includes haphazard selection, random but without a strict method, and block selection, picking items next to each other. But here's the catch: non-statistical methods rely on judgment, so there's a risk of bias. Still, they're useful for focusing on high-risk areas. Uh, okay, so let's continue from here. We'll talk about deviations. These come up during the test of controls. Basically, when a control doesn't work properly, so what does the auditor do? They set a tolerable deviation rate, how much error they're okay with. Um, then they test a sample, and if they find deviations, they extend the testing. After that, they compare actual deviation with tolerable deviation. If actual is higher, they can't rely on controls and hence increase substantive testing. Plus, they report these control issues to management. I'm not going to be discussing the examples, so let's move on. Yeah, just give me 1 second. Okay, so misstatements. Misstatements are actual errors in numbers, difference between what is recorded and what should be recorded. They are found during substantive testing. Um, so once the auditor finds a misstatement, they first ask: is this just a one-off error? Is it an anomaly, meaning isolated? Then no further action is needed. Easy. But if it's not isolated, then the auditor projects that error across the whole population. Basically, they estimate that the total error could be. Then they compare this with a tolerable misstatement. If the projected error is less than tolerable, all good, low risk, no extra testing needed. But if it's more than tolerable, big problem. The auditor has to increase testing to get a clearer picture. And finally, they communicate the misstatement to management and ask them to correct it. Uh, okay, so let's quickly understand automated tools and techniques, um, which is related to test data. Test data is when the auditor inputs dummy data into the client system to check if it processes things correctly. Basically, does the system catch errors or not? To make this work, the auditor uses both normal data and data with intentional errors. For example, invalid customer or supplier codes transactions above limited allowed limits, wrong calculations, or incorrect totals. Now, this testing can be done in two ways. First, live testing. Um, During normal operations but risky, it can mess up real data. and debt testing outside normal operations safer but doesn't fully reflect real system pressure. So both have pros and cons. Big advantage of test data, it helps test automated controls that you can't check manually. Once set up, it's cost effective. Yeah, unless the system changes. Let's talk about the advantages and the disadvantages also. It can actually damage the client system if not handled properly, and if done in a live environment, it can interrupt normal operations which clients don't love. Now, about audit software. This is used to analyze a client's data, either ready made software or custom built. Bigger advantage, it can handle huge volumes of data faster than humans, and auditors can use it to select samples, random or high value calculated ratio. Recalculate numbers like depreciations on yeah, compare budget versus actual stratified data, um, and even spot unusual changes like bank details. Basically, it helps identify risk areas and speed up testing. Advantages, faster calculations, data tested, and more efficient than manual work. But remember, it's just a tool, it does not replace the auditor's judgment. So let's talk about the disadvantages of audit software. It can be expensive to set up, especially if it's custom made. Staff need training, more cost. It might slow down and even affect the client system. And if the software is designed wrong, errors might go unnoticed. Now, automated tools in general advantages. You can test more data much faster, uh, test actual system instead of printouts, compare results easily, and overall more effective and cost efficient. But there are downsides too. They can be expensive and time consuming to set up. Clients may not always cooperate, systems and not be compatible, and the audit team might need the IT skills needed. Plus, there's always a risk of data corruption. Now, quickly, there are two special tools: integrated test facilities. Dummy records are built into the system so test data can run live without affecting the real outputs. And embedded audit software, a program built directly into the client system. They can be turned on anytime to monitor transactions. Super useful for tracking important or unusual items. Okay, so let's move on to data analytics. Data analytics is being used is basically using technology to analyze data, find patterns, spot unusual items, and extract useful insights from the audit. But when we talked about big data, it just means huge or complex data sets. The big advantage, auditors can test entire data sets instead of just samples. Now, where is data analytics used? Pretty much everywhere. Planning, risk assessment, testing controls, and even substantive procedures. It can also use a wide range of data like industry data, economic data, even social media. Now, let's talk about benefits. It improves audit quality, gives better understanding of the business, and helps auditor apply better judgment. It also reduces audit sampling risk because you can always analyze 100% of the data. Plus, results can be shown visually, making reports easier to understand. Audit becomes faster and more efficient and can even be done continuously throughout the year. So, reporting is quicker and there's more interaction with the client. Only downside, more efficiency can mean fewer billable hours. Okay, so let's talk about the limitations of data analytics. Even though data analytics is powerful, it's not perfect. First, it depends on the quality of data. If the data is incomplete or unreliable, the results will also be unreliable. Second, financial statements still involve estimates, and no amount of data can make 100% accurate estimates. Third, it does not replace professional judgment or skepticism. Auditors still need to think and question everything. So even if 100% data is tested, auditors still only give reasonable assurance, not absolute. Now, how are automated tools used during the audit? At the risk assessment stage, data analytics can analyze journal entries, like how many are manual versus automatic, who is posting them, and even the time they are posted. Red flags: too many manual entries, too many people involved, or entries posted at odd hours. It can also help with ratio analysis and understand how transactions flow through the system. At the substantive stage, um, Tools like drones can even be used to inspect inventory. And data analytics helps with trend analysis, ratio analysis, and spotting unusual balances like zero balance caused by offsetting entries. So remember, data analytics is powerful but not foolproof, and auditors still rely on judgment to make final decisions. Okay, so what does this mean for the profession? Big audit firms are investing heavily in their own data analytic platforms. They are talking serious money on tech training and systems. Smaller firms, they usually can't afford that. So they rely on ready-made software that works with tools like accounting systems. Mid-sized firms are kind of stuck in between. They must struggle to compete with big firms for larger audits but can still offer other valuable services. Now, here's the big shift. Traditional auditing focuses a lot on internal controls, but data analytics is changing the game. It's moving audits towards more data driven testing. Because of this, auditing standards will also need to evolve. Regulations and auditors need to work together to make sure audit quality actually improves with technology. And honestly, business today are more complex, there's more data than ever, and more regulations too. So naturally, people expect auditors to use more advanced tools like data analytics. But here are the challenges. Only big issue is data security and privacy. Auditors need access to huge amounts of client data, which creates risk and storage problems. And conceptual challenges, which is the auditors are now asking totally new questions, and clients might hesitate to share that much data. Legal challenges, sometimes data can't leave the country, which becomes a problem if systems are located elsewhere. Resource availability, data experts are limited, so everyone is competing for the same support. Even regulators are catching up. They don't have much experience inspecting audit using data analytics yet, and auditors themselves need retraining, shifting from traditional methods that takes time and money. Now the impact. Just one second. Now the impact on auditing. Risk assessment improves. More data equals to better insights. Quality control becomes more complex. Firms need to ensure that software actually works properly. Group audits become easier. More centralized testing rests less reliance on other auditors. Estimates and fair values. Data analytics helps handle large complex data inputs, but smaller firms may struggle due to high cost and lack of resources. Education also needs to change. Future auditors must learn data skills, and ethics becomes even more important because auditors now handle massive amounts of sensitive data. Finally, audit standards themselves may need updates to keep up with the technology. Okay, so let's quickly look at FRC review and on data analytics in audit. With data analytics becoming more common, the FRC reviewed how biggest audit firms are using it. So, what are auditors actually doing with data analytics? They analyze entire population of data, break them into groups, and spot unusual items for further testing. They also perform recalculations, uh, match transactions through systems, and help test segregation of data. Um, Segregation of duty, sorry. Compare client data with external data and even run sensitivity analysis. Now, what's the impact on audit quality? It improves understanding of the business, helps focus on high risk areas, strengthens professional skepticism. It also improves consistency in group audits, allowing testing of full data sets and increase efficiency. And yes, even increases the chances of detecting fraud. Less communication with audit committee becomes better. Now, what did they find works well? A proper rollout of tool, clear integration with audit methodology, testing the tools before full use, with using specialist teams with clear roles, centralized use, not group audits, and proper documentation. Okay, so this mandatory rendering in the UK has pushed firms to develop data analytics tools to stand out from competitors. In fact, UK firms are leading in this space. But here's the issue: the pace of the world is still slower than what investors expected. Some firms are investing heavily in data analytics but are not tracking how effectively teams are using it. Even worse, some audit teams are overhyping their use. In some cases, data analytics was used just to give insight to audit committees, not actually to generate audit evidence. But sometimes tools were claimed to be launched but were still in testing stage. Now, where is data analytics actually being used? mostly in journal entry testing, but not widely across other audit areas yet. Also, for complex companies, it can take up to 2 years to fully benefit from data analytics. Biggest challenge: getting the data and having the skills to use it. Firms that clearly define how to use data analytics in the audit procedures performs much better. And finally, a major issue with documentation: audit files don't have enough evidence, missing inputs, incomplete screenshots, missing specialist work, uneven system unable to perform the data properly. Okay, so let's wrap up our chapter. Okay, so the IAASB actually asked firms and regulators, where is audit technology heading? And the key takeaway: auditing standards are not broken, they should stay principle based but slowly evolve with technology. Some standards like audit evidence and documentation may need updates to reflect modern tools. Also, auditors need practical guidance, real life example of how to actually use data analytics. One thing is very clear: data analytics does not replace professional judgment or skepticism. Now, what are the main concerns? First, data access. Clients may not allow full access to other systems, which affect reliability. Second, skills gap. Many auditors don't have strong IT knowledge to use full data analytics. Third, compliance. Even with data analytics, auditors must still meet all ISA requirements, especially documentation. And it's not just auditors, even regulators and audit committees need to upskill to understand this new approach. With this, we have completed our chapter number 7. Hope you found this video useful. If you did, please share it with your friends, and please leave a like and a comment. It really up yeah. So it really means a lot to me if you do comment, if you like this video, if you found it helpful. And yeah, that's it for today. And if you want more such videos, please do subscribe. Thank you so much for watching.